If you have federal student loans, or you're about to take one out, July 1st, 2026 changes everything. This is not a small policy tweak. This is the biggest overhaul to federal student loans in decades. Income-driven repayment plans you've relied on for years are gone, and they're being replaced. 7.5 million people on the SAVE plan have been given a 90-day countdown. New borrowing limits, new repayment options, and new deadlines are coming. If you do nothing, your loan servicer will pick a plan for you, and it might not be the right one for your situation. In the next several minutes, I'm going to walk you through exactly what's changing, who it affects, and the specific steps you need to take before and after July 1st. This is real information, straight from Department of Education guidance and verified reporting. No fear-mongering, no fluff. Let's get into it. First, let's talk about why this is happening. These changes come from the Working Families Tax Cuts Act, also called the One Big Beautiful Bill Act, which was signed into law in July 2025. The goal stated by the Department of Education is to simplify a confusing system. For years, borrowers had to choose between 4 different income-driven repayment plans. Those were SAVE, PAYE, ICR, and IBR. Each one had different rules, different formulas, and different forgiveness timelines. Starting July 1st, 2026, that maze collapses into just 2 options for new loans. Those 2 options are the Repayment Assistance Plan, known as RAP, and a new tiered standard plan. But here's the part that affects almost everyone with existing debt. The SAVE plan, which around 7.5 million borrowers were enrolled in, has been ruled unlawful by federal courts after a legal challenge from the state of Missouri. It's being shut down completely. If you're one of those 7.5 million people, this video is critical for you. Now let's go through exactly what's changing. In plain English. There are 5 big changes you need to understand. Change number 1. The SAVE plan is officially dead. If you're currently on SAVE, you've likely been in administrative forbearance for almost 2 years, while courts fought over its legality. The Department of Education has now begun sending official notices. Starting July 1st, you get a 90-day window to choose a new legal repayment plan. Your choices are IBR, ICR, PAYE, or the new RAP. If you don't choose, your servicer auto-enrolls you in one. That auto-enrollment might cost you hundreds of dollars more per month than the plan that actually fits your income. Your action step is simple. Log in to studentaid.gov today and check your current status. Don't wait for the notice to arrive. Be proactive. Change number 2. The new Repayment Assistance Plan, or RAP, explained. RAP is the new income-driven plan, and it works differently from anything before it. Your monthly payment is based on your adjusted gross income. It ranges between 1% and 10% on a sliding scale. Here are real numbers from the Department of Education. If you earn $30,000 to $40,000, expect to pay $75 to $100 per month. If you earn $50,000 to $60,000, expect to pay $208 to $250 per month. Here's what makes RAP genuinely different and better in some ways. If your payment doesn't cover the interest accruing that month, the government waives the difference. Your balance can't balloon from unpaid interest anymore. There's also a matching principal benefit. If your payment doesn't reduce your balance by at least $50, the government adds enough to make sure it drops by $50 anyway. And if you're married and filing separately, you're now assessed on your income only, not combined household income. That's a major win for 2-earner couples who were penalised under the old plans. But there's a catch. Forgiveness under our app takes 30 years, which is longer than the 20 to 25 years under old plans. And it's not indexed for inflation, so a raise could unexpectedly spike your payment. Change number 3. the new tiered standard plan. This replaces the old standard, graduated and extended plans. Your repayment term now depends on how much you owe. If you owe under $25,000, your term is 10 years. If you owe $25,000 to $49,999.99, your term is 15 years. If you owe $50,000 to $19,999.99, your term is 20 years. If you owe $100,000 or more, your term is 25 years. A bigger balance means a longer term and a smaller monthly payment. It's simple and predictable. But it also means a longer relationship with debt if you have a large balance. Change number 4. New borrowing limits. And this one is critical for students and parents. If you're taking out new loans on or after July 1st, here's what to know. Graduate students are capped at $2,500 per year with a $100,000 lifetime limit. Professional students in fields like law, medical and dental school are capped at $50,000 per year with a $200,000 lifetime limit. Parent Plus loans are capped at $20,000 per year per student with a $65,000 lifetime maximum. And here's the big one. Grad Plus loans, which previously let graduate students borrow up to the full cost of attendance, are being eliminated entirely for new borrowers. If your graduate programme costs more than the new caps allow, you'll need to look at private loans to cover the gap. Undergraduate loan limits stay mostly the same. That's $5,500 in the first year, $6,500 in the second year, and $7,500 in the third year and beyond. The total is up to $31,000 for dependent students. Change number 5. This is the critical trap of mixing old and new loans. This is the part almost nobody is talking about, and it could cost you the most. If you already have loans from before July the 1st, 2026, and you take out even one new loan after that date, all of your loans, including the old ones, get pulled into the new system. You lose access to your legacy repayment plans entirely. You get locked into RAPE or the tiered standard plan only. This matters enormously for current students. A senior taking their final loan disbursement in fall 2026 will have their entire loan history, going all the way back to freshman year, moved under the new rules. If you want to preserve access to your current repayment options, the only way is to finish borrowing before July 1st, 2026. Now let's get to the most valuable part. Here is your specific action plan based on your situation. If you're currently on the SAVE plan, here's what to do. First, log in to studentaid.gov this week and don't wait for the email notice. Second, use the department's loan simulator tool to compare IBR, RAPE, PAYE and ICR based on your actual income and balance. Third, submit your application for your chosen plan before your 90-day window starts counting down. And fourth, if you provide IRS consent for income verification, the application takes about 10 minutes and processes faster. If you're on PAYE or ICR, here's what you need to know. These plans are being phased out by July 1st, 2028, not immediately. You have time, but don't wait until the deadline. Compare your options now. If RAPE or IBR would lower your payment, switching early means you start benefiting sooner. If you're on IBR, there's good news. IBR survives. You can stay on it or switch to RAP if the numbers work better for you. Run both scenarios in the loan simulator before you decide. And if you're a current student planning to borrow more, this is your critical decision point. If preserving your current repayment flexibility matters to you, try to complete your final loan disbursement before July 1st, 2026. If you need to borrow after that date regardless, understand that all your loans, both old and new, will move to the new system. So let's bring this all together. July 1st, 2026 is a hard line in the federal student loan system. The SAVE plan is ending, and 7.5 million borrowers will need to choose a new plan within 90 days. RAP brings income-based payments, interest waivers, and a principal match, but a longer 30-year path to forgiveness. The tiered standard plan ties your term to your balance. New borrowing limits arrive, and Grad Plus loans disappear for new borrowers. And mixing even one new loan with old loans pulls everything into the new system. The single most important thing you can do is act early. Log in to studentaid.gov, run the loan simulator, and make a deliberate choice instead of letting a servicer choose for you. Knowing these rules before the deadline is how you protect your money and your options.